Hello, chart watchers, and welcome to this Friday, January 4th, 2019 Market Watchers Live show with your hosts, Tom Boley and Greg Schnell. Greg is sitting in for Mary Ellen McGonigal, who is unable to be with us today. Mary Ellen will be back next Friday. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Dow Jones up 630 points. The S&P, the 2520 level that I was referring to at the end of December, early January, we're right up there currently today, up 71 points. The NASDAQ up 245 points. Beautiful move on the NASDAQ. Russell 2000 up 43, almost 44 points. 10-year Treasury yield finally getting a bounce to the upside, up 10 basis points today. So we are seeing money rotating away from the defensive Treasury market. That is helping to sustain this move to the upside in our equity markets. Volatility index has been on the move lower over the past 7 trading sessions. That continues today, down 12%, down more than 3 to 22.5 currently. Technology having a great day, bouncing back from Apple's warning that we saw yesterday. Technology currently up nearly 4% today. Communication services also doing well. These two groups benefiting from a lot of different areas of strength, but particularly software, which is up 90 points today. So that is up roughly 4.5%. And internet stocks also having a very strong day. Among the best performers on the Dow, you have Intel, which is up more than 5%. And the second best performer on the S&P 500 is AMD, another semiconductor, which is up 8.7% today. The only S&P 500 company that was performing better was Mattel, which was up roughly about 10% at last check. All right, Greg, there's been a lot going on since you were on the show with me. And first, I want to thank you for coming in and subbing for Mary Ellen, who could not be with us today. But what do you think with everything going on? I mean, we got the big jobs report. We had a big warning from Apple yesterday. You know, market down yesterday. Now it's rallying back today. I mean, what do you think's going on here?
We are definitely living through some wild swings. I do remember back in 2008, and it was like, the market would fall 800 points. And just when we're thinking the best thing in the world was to be shorting the market, all of a sudden the next day would be up 1,000. Or it would just, the yo-yos were so big. And I feel like we're in that again, where we're just, when we get this high peak in volatility, all of a sudden it just holding from day to day is even more difficult because the portfolio is swinging so wildly.
Yeah, I mentioned a few days ago I had started to build a short position. Actually, it was 2 days ago, back on Wednesday, and I had the SDS. And yesterday, everything looked great on the short side, and I was thinking, okay, we got a jobs report, but the ADP employment report had come out pretty good on Thursday and didn't really seem to help the market. We had the Apple warning. So anyway, I did the prudent thing at the end of the day yesterday. I was like, okay, I need to sell some of this SDS. And I was telling you before the show, I kind of was thinking, okay, do I sell 20%, a third, maybe 50%? Of course, I only did the 20%. So I held 80% of it to wake up today to this huge jobs report. And I'm chuckling, but it's really out of frustration more than anything. As I got stopped out early in today's session because the market just completely reversed. And this is what I've been talking about, and we've been talking about on Market Watchers Live now for weeks. This high volatility, you don't know from one day to the next what you're going to get. You think you got a strong market. Next day it's weak. Then, okay, you're rolling over. You're going lower. Wait, nope. Now we got a big gap up and another move to the upside. This is why it's really difficult to trade. And personally, why I'm staying away from individual stocks. I mean, we'll get into the show here in a second, but how are you approaching the market on a day-to-day basis? Are you trading individual stocks? Are you trading fewer positions? Are you sitting on the sidelines? What's Greg Schnell doing?
I'm trading way fewer positions. I'm long some gold stocks, and I just got long some oil stocks. Late last week, actually, I got long some oil stocks. But the big thing that I'm working toward is, and it'll be a big deal for me, is, when you're using weekly charts and the charts are moving 5% a day, the weekly chart really doesn't help you that much. So I'm really trying to shorten my chart focus. When you're getting these big swings, you don't need to hang in there for 3 months to get 10%. You might have to hang in there for 3 days. So So I'm trying to get better at going to a shorter time frame, maybe a 60-minute or a 30-minute time frame, just to keep track of the momentum a little bit closer. As an example, today, this is probably one of the first days since mid-November that we got an upturn on the actually it was early November, an upturn on the MACD for the S&P, and we're moving above the 20-day moving average, or we're right at it right now. So kind of looking for some breakouts to the upside here. I did an end of the year review and talked about going back and looking at the similarity between 2018, comparing it to 2007-8, and that was crazy how similar we've been so far on the move. So
yeah, we're going to get into a lot of that. I know you've been following some of the Pring charts, and I know that kind of gives a completely different perspective than what you normally would see on CNBC, and so that's going to be exciting. Let's get into what we're going to be going over here today. First, the upcoming schedule. We do have Greg Schnell, believe it or not, coming back on Tuesday. Don't know if you knew it, Greg, but you're going to be back on Tuesday with us and going over the dollar. And then Wednesday, we got Greg Morris joining us. Next Thursday will be Grayson Rose. And, of course, as I mentioned earlier, Mary Ellen will be back next Friday to take a look at what's hot, what's not from her perspective. Today's agenda, well, we've got a lot going on. We got the what's hot, what's not. Greg and I are going to try and step into Mary Ellen's shoes. I can guarantee you we won't go over as many stocks as she does, but we'll try to get you up to date on what's been hot, what's not. The 10 in 10 first stock today will be Electronic Arts, EA. Nice positive divergence there. The stock's been rallying. We'll see maybe what's going to happen from there. And then what would you do? What would you do with Apple? Stay tuned. Greg and I are going to share our views on what we think of Apple and with the warning that they came out with, the big drop yesterday followed by the rally today. A lot going on there. But let's go ahead and get into first the economic news today. There was a bunch of it out. Of course, it mostly centered around the jobs report. So first we had the non-farm payrolls out this morning. And if you recall, yesterday, the ADP employment report came out way better than expected. And that was a precursor to what we are seeing this morning, or what we saw this morning on non-farm payrolls. 312,000 actual versus 180,000 expected. Very strange the way I look at the market. Normally, as the market begins to roll over and you head into a bear market, we see a deceleration in jobs, and yet December is showing an acceleration. Kind of interesting. Unemployment rate, though, was a little bit higher than expected, as was the average hourly earnings. 0.4% versus 0.3%. And December PMI services came in a little bit higher than expected, better than expected, 54.4 versus 53.4. It was down from the November level. I think that was at 54.7. And it also was nice to see PMI services higher than expected after we saw PMI manufacturing come in disappointing yesterday. Let's take a look at the 10-year Treasury yield. I mentioned this at the top of the show. It is rallying. We are now back up at 2.65%. I think what's been going on, though, the last 2 months, yes, it's a nice rally. We've had a couple of these, but we haven't been able to sustain these moves to the upside. We've had a lot of movement into treasuries over the past 2 to 3 months, and that's why the double top in the Treasury yield has printed, and we have seen this downtrend now over the last 2 months. A lot has changed in the stock market over the past 2 to 3 months, and I think the 10-year Treasury yield is just one big example of just that. All right, as far as earnings news, we did have a couple of earnings reports out. They'll begin to start picking up next week. 2 or 3 weeks out is when we'll really get slammed with earnings reports. We've seen the warning from Apple. It's going to be interesting over the next couple of weeks to see if any others come out with warnings based on the huge fourth quarter drop we've seen in the equity markets. Lamb Weston reported 80 cents versus 70 cents. This is a food products company. They actually raised guidance as well. They beat on the top line. RPM International is in the specialty chemical space, I believe. And that company did report revenues below expectations, $1.36 billion versus $1.38. And they fell short on the bottom line as well, 0.52 versus 0.66. But first, let's take a look at Lamb Weston and see what that chart is telling us. All right, Weston here. We did gap up with that news. Again, I mentioned the beat on the top line, bottom line, and raised both fiscal year revenue and earnings per share guidance. So all of that going on, the stock was up to 77 earlier, got up to 76.88, has reversed lower, but it is above its 20-day moving average, which it had been struggling with. You can see that the breakout that occurred back in October was above 72.5. When we pulled back, we essentially held that level, went just below 1 day, and then rallied back up above it. So this is a stock that actually is in a more defensive area in the consumer staples, and it's performing well and raising guidance. So if I was going to trade on the long side, I think a company like this makes a lot of sense. RPM, this is RPM International in the specialty commodity space. And you can see here to the downside, the stock had been breaking down. And when you look at the overall group, the group has been very weak in the fourth quarter. Topped toward the end of September, sold off like many areas of the market. But RPM did not sell off as much. In fact, when we were breaking down here in the second week of December in the overall group, RPM was actually holding up and holding on to its prior support. But it too has since fallen below support. And now with its earnings coming up short, the stock continues moving lower, and you can see on a relative basis, it is diving versus its peers. One thing I wanted to show was on the members dashboard, if you go over under the control center to the sector summary and pull that up. Of course, this is a great way to just get a real quick analysis of what is driving the market. You can see technology, communication services, materials, industrials, consumer discretionary, many of the aggressive areas of the market performing really well today, and that's a good thing. Unfortunately, when we pull up the scooter rank, which tells us on a relative basis how these groups have been doing, look what's leading to the upside, on the upside. Utilities, healthcare, consumer staples, real estate. That is normally not what we want to see, and it's rather indicative of the weakness that we have seen in the stock market. Down the downside, look at technology now, down to 17. That's the lowest I've seen the technology ETF in a long, long time, and it didn't help with the news that we got from Apple yesterday. Speaking of Apple, let's take a look at the chart quickly. Apple did gap down, broke below the support. It is trying to rally today. I'd like to see it finish strong, and we want to watch for reversing candles. But if we go back on Apple, earlier in 2018, we had the February low down here, which was just below the 150 level intraday. We went down there again in December, bounced, and then we gapped on very heavy volume below this level. And it looks like maybe we're just coming up to test this area. A reversal on Apple would not be a good sign, something to watch as we go forward. All right, Greg, I know we talked, kind of teased everybody a little earlier. You got some Pring charts you want to show. Doesn't paint a very pretty picture. What you got?
My good friend, Mr. Pring. He has great charts, and for many of you who have had the pleasure of working through Martin's stuff, I think one of the big things Martin does better than any of us is he looks at big picture. And this chart goes back to 1930 to 2010, and this is the inflation-adjusted S&P composite up at the top. So Martin's take off the effect of inflation, and you can see we've broken this trend line. What happens here is he's compared the price-earnings ratio, the Shiller PE ratio, with the bond yields. And you notice that whenever you kind of broke above this line back in the 50s and 60s, that was a big deal. And then 1960 to 1980, the stock market gently jogged lower with lots of good rallies in there, but in general, it was downtrend. Finally broke out in early 83. This ratio popped to the upside, and it started an 18-year trend. The problem we have right now is this ratio is at an all-time high and has rolled over not only below his 48-month moving average, but below this uptrend line. And this is pretty concerning just because of, especially from the ground we're coming from. And we all know it's different this time, but that's the problem. So the second chart that I want to talk about, and I'm going to spend just a little bit more time on this one. So this is the inflation-adjusted S&P composite. Martin's drawn 4 trend lines on here. Down at the bottom, he's inverted the dividend yield. So higher means a smaller dividend and lower means a higher dividend. But he did it so that it compares with the chart, so the downtrends match. And what you see here is the dividend yield is starting to roll over from a pretty high level, but it's also making a lower high while the market made a higher high. So there's some divergence here. And you can see in general, there was a bit of a weakening trend, but now we're breaking this uptrend line as well. And it's only 9 years long, so let's not worry about that. It's a significant place to break. And again, early in 2018, it didn't get touched even, but now all of a sudden we're starting to crack through this data. And the same thing happens here on the Shiller PE ratio, where this is taking the price earnings ratio, and as it changes, it's a 48-month moving average. And when it rolls over, what we see is, this is a place to be cautious. Now, you can draw some shorter trend lines here in this. All of a sudden, it broke out and kept going. I think the macro picture on this is that we've only had PE ratios this high 3 times in 100 years. And of those, again, while it's still rising, it's all good. But once it starts to roll over, you want to be aware of that. And so in 2016, we briefly rolled over and we broke this short uptrend line. All of these charts would have triggered a signal, and then only to turn around and reverse right after the election, or just before. It was a Fed meeting there, and we started to climb higher and continued to roll up. So now we've snapped it again. So this is a 10-year trend line. And, again, could it be a false breakdown like maybe this one and continues to go higher? It certainly can. But the bigger thing to remember in all of this is that this is the 3rd highest PE ratio. That chart I just showed you was all-time highs on the ratio of bonds to stocks to bonds. So we're really offside. Like, everything is at the extreme top edge of the chart. We're fighting in the right-hand corner. And now we're getting these sell signals. If these sell signals were isolated to just, a few charts, that would be fine. But I think the bigger picture that we've seen with the depth of the pullback and everything is there are so many things that match up with a major bear market, including the rest of the world falling below its 20-month moving average. So all of that lines up to me that, if nothing else, put it in the backdrop of your investing strategy that we could be breaking some major long-term support levels from really high levels. And again, let's not forget that the stock market, let's just say in 2007, when we topped out at about 1575 or whatever, let's call it 1500, and we're at 3000 now, or 2940 was our high. We're almost a double off the tops, and off the lows, we're up 5 from 660 to 3000. Let's call it 4x at least. So everything says we've come a long way, and we're at really big extremes. So with that, I would just say, I'll wrap it up so we can get into our next segment, but go to Martin Pring's blog and click on this. And if there was a reason for membership, it's time like this to check out these really great charts from Martin. But under Martin's blog, it's for members, and in there you'll see his latest monthly review.
All right, awesome. Yeah, and these charts, and again, this is just something that Martin does. You're not going to be able to create this particular chart yourself on StockCharts, but it is something to think about. And Greg, you and I were talking before the show, and I'm a trend line fan, but I'm also cognizant of the fact that you can kind of move these trend lines around. So I'm a little skeptical by the trend lines and whether or not if we're truly breaking an uptrend or not. But it literally is up to each individual to interpret the charts as they see them. I think with everything going on in the market, I think that this is at least something to consider, the fact that these could be rolling over and the ramifications that we've seen in the past when they've rolled over. So I think it's great to bring it up. And again, if you want to read more about that, you can go in and take a look at Martin's blog. You do need to be a member at StockCharts because his blog articles, for good reason, are behind the paywall. But excellent work by Martin, and thank you for bringing that up, Greg. All right, we're going to get into what's hot, what's not. As I said earlier, I don't know if we can keep up the pace that we normally see with Mary Ellen on here, but Greg and I are up for the challenge. We are going to go straight into the what's not. And Greg is going to go over those, and I'll be on a little bit, tell you what's hot. Go ahead, Greg, take it away.
And so I'm going to cover off bond yields a little bit. And we mentioned that they're up today and trying to bounce. And the one perspective that I'd really like to share with people on the bond yields, because it is a really big part of investing. And I just mentioned that all of those ratios were way out of whack on the other page there, where the price earnings ratio compared to the bond yield ratio was at like an all-time high, and we're swinging the other way now. So right in here, Jamie Dimon said, get ready for 5%. And even his bond team came on TV and said, well, we aren't ready for 5%. But, you know, this is when you really get people starting to predict the doubling and that kind of stuff. It's a pretty important place to pay attention. And here we have, you know, I think Apple, people talked about going to 2 trillion. So here we have a failed breakout where basically we had this exhaustion push up, didn't make any headway, and rolled right back down, and then started to break this uptrend line. Now we've broken through the moving average and bond yields are falling. This isn't a surprise. So this was my PPO indicator that I like to use, and I like to use it because it does a great job. A lot of times you can put a trend line across the top of the PPO peaks, and what you find, really what we're talking about is the slope of momentum with that. And what you normally see is when the trend in momentum breaks, that would be something different. So as an example, down here you had a declining trend, and right in here you get this trend line break, and it's a place to consider something different. Same thing here, a big downtrend for 9 months or whatever, and you get a break. Now here we are, and we're just falling below zero. And I know most people want to believe that we're going to go to 5% because that's the big picture. That chart I just showed of Martin's suggested that bond yields as a ratio to stocks are at an all-time high, and this would probably be an important inflection point if it was to go the other way. The point that I would like to make here is that the PPO trend line has been putting in a series of lower highs, while the market's putting in a series of higher highs. And so as these yields fall, what that means, so yield down, price up, is that it might be, at least for a period of time here, it might be more prudent to have some money in bonds, even though everybody keeps talking about, you know, we're going to go to new highs and bonds and all that kind of stuff. All of these indicators are suggesting that we're rolling over quite hard. And we did have an uptrend line in here that broke earlier, and basically we came down and just on the final high had a lot less momentum. And you can use this momentum curve on many of the stocks we follow. I use it all the time. If you haven't followed my weekend wrap, you'll find that I'm always talking about the PPO. And as it goes below zero, that's just a great place to be aware of. Back here, as it fell apart in 2016, even though the market started to rally, we still found bond yields falling. So the point I want to make on the bond yields especially is that we need to stay focused on making sure that as the market changes, we're listening to the market and not to the commentary. And the idea would be that, you know, here we're almost at 12-month lows on the 10-year, and yet most people are still talking about a bond bull market. So I want to caution you that usually you don't get 52-week lows in a bull market, and this is going to be a very tenuous place, right? It would just be below 2.5% right now, would get us into a 12-month low. So watch closely. I think that's a big area to be concerned about. This is a chart that I've been using lately as the treasuries unwound. And what you see is early last year, we had big spread on the yield curve. So the 1 year and the 2 year and the 3 year and the 5 year, and everything was stacked in a logical order, same as the table up at the top. Now we have it all mixed up. Here, the blue line is the 1 year. What you see is the 2 year and 3 year and 5 year are all below that. The 10 year is almost where the 1 year is. And so the 2 and the 10 haven't crossed yet, but there's been a lot of mayhem with longer term rates well below the short term rates. And so as we get this crossover effect, this is what we what we're always looking for on the yield curve. With that sort of setup, it's not a good market timing thing because it could take almost 6 months for a recession to show up or something like that. But it is one of those fuses that needs to be lit or is commonly lit to help show us that things are weakening and that money is getting split out, separated based on term. So I'd strongly encourage you to pay attention to the yield curve. Again, I go back to that last chart, and I think we're just in the beginning. And if you follow my weekend wrap, I'll be covering off the monthly charts now that we've hit a year end, and I'll go through all of those. And the big thing that we're looking for here is what is the big trend over a period of time. And this isn't a very important failed breakout. So I would caution you on getting too bearish on bonds. The next thing I want to talk about briefly is the retail. What I've done here is just set this to 3 months. And if we just pick, what are all the top stocks, there's some good ones hiding in here. But on the other end of the scale, some of these names are off 79% in 3 months. These are just so big. And, when we look through these stocks all the way through here, normally the first quarter is quite bullish for retail. But I would caution you to make sure that when you're looking in the retail, like here's Michael Coors, quite a common stock for us. And, this is a pretty depressed chart. It may rally. It could come all the way up to the 200-day and still be on the underside. So it could move 50% and still be under the 200-day moving average. That's a pretty significant change. So while I expect some rally in the first quarter for retail, I think you really need to use things like the scooter ranking to help you, or just be aware of the 3-month progression on these. So again, the way to do that is just set this to either 3 months or 6 months, whatever you want a time frame, maybe 1 month, and then you can use the scooter ranking, and it'll just pop all of the top stocks to the top of the list. I usually like to look in around the 75 level as stuff is starting to move around there, and if we just highlight those, this one's starting to bounce. Here's Ulta Beauty. That one's been pretty nice. So it found support right around that 230 level and perhaps is ready to start heading back up. But be very selective if you're going to trade that retail for the next 3 months. I think there could be a lot of tricky trading there as we go forward. Lulu's been a darling lately, so watch closely to see if that one can go. Foot Locker is actually behaving better than Nike, which is an important one. So I like that area, but you have to be very selective. So in terms of what's not hot, a lot of retail is not hot. But what I'd like to look for is using the scooter ranking or even the past 3 months performance to try and find what held up better. Lastly, I'd like to just go through a few of the transportation stocks. And one of the things that I want to talk about here, most people would assume that with lower crude, these transportation stocks would do better. And United Airlines, sorry, I should describe this first. This is my weekly chart. I have the scooter ranking at the top. I have a relative strength ranking here, and then a full stochastic, and a full stochastic on a pretty strong stock. So a stock that's got an uptrending relative strength and comes down and touches is a nice place to look for entry. And again, for trading, that's fine. I think the bigger thing that we want to worry about here in general is making sure the 200-day or the 40-week moving averages hold on these charts. So United Airlines is probably the brightest one out of the group. And I would just draw a trend line on this relative strength. And for the most part, you can see that when these trend lines break, it's probably a good place to get out. Even if you got out here, you'd have been out and missed kind of 4 months of nothing. But you want to try and find things that are outperforming. And this has pretty much all year has been outperforming, but just draw a trend line under it. And if that starts to break, so as an example, your price trend line is here and that's clearly broken, but your relative strength trend line has not broken. And so I would just make sure that this stays above. And we're going to talk about this relative strength action on a bigger picture for some other stocks later today. But one concern I have is the PPO has already broken down. And so usually when this happens, this is going to end up being a false rally. So I would be very, very cautious here, trying to get long the airlines at all, even though this one has been such a good performer. If we go to American Airlines, not such a good performer, and we're just not really seeing any upturn in momentum here. If anything, I would draw a trend line across my PPO, and if this didn't start to improve, I wouldn't get interested. And the same thing here on the relative strength curve. We'll just do a couple more. So here's Delta Airlines. And what we see on that one, of course, is it's broken to new 52-week lows. That's usually not seen in an uptrend. And even worse is that this stock basically, in terms of relative strength, never really gets a big run going. Hasn't had that for a couple of years now. So I would encourage you to just this one's a miss for sure. And if we picked something else like Love or whatever, Southwest Airlines, you can see this one's at a new 2-year low. And so I wouldn't jump in front of these trucks here or these planes. I don't think they have any upside momentum that's really going to help us. And again, the strongest one in the group looked like it was weak to me. There is a giant trucking company called Schneider with orange trucks driving around, and I don't even know how many power units they have. It's something like 6,000 or 10,000, or it's a crazy number. It's a huge company. Anyway, they went public about 2 years ago, and you can see they've returned all the way back to their initial public offering. And now what we're watching is to see if there's any price action coming out of the hole. And you've got a big downtrend here in relative price performance, but trucking is usually a pretty good early indicator, and things like Carrier refrigeration units on trucks and Thermo King refrigeration units, those can help be an early warning signal, or new trailer orders. Until this starts to get a relative strength improvement on things like this, I would miss the FedEx as your clue and look to something more like Schneider National or something like that for a clue. And of course, with that, that leads me into FedEx, and they obviously had the big warning, and that was just a plummet. So, I don't think you want to catch this falling knife. I would wait for this big PPO relative momentum downtrend or momentum downtrend to break before I entered that trade, much like it did over here. When this trend line broke, it was a better place to get involved. So you can be patient here. I wouldn't try to fish the dish and see if you can find something right at the bottom. I'd probably wait for something better. And lastly, I'm going to do UPS, and then I'll turn it over for Tom to cover off what's hotter than these weak ones. So this is almost a 3-year low. And again, no relative strength for a couple of years. So no real reason to enter these trades.
All right. It's a pretty good synopsis of a lot of things that aren't necessarily going right with the market. I know FedEx and UPS both really getting hit hard. And a lot of these transportation services, freight companies, things really fell apart in the fourth quarter, which just seemed like, I don't know, underscoring a lot of the economic weakness that the market sees as we go out into 2019. Would you agree with that assessment?
I do. And the one thing, and I said this before about trucking and the oil business, but the oil patch takes heavy stuff to the middle of nowhere and drills a well. And so when the oil patch slows down, usually trucking isn't far behind. And it's not that it's the only thing they haul, but they haul a whole bunch of stuff to nowhere. So instead of just big city hauling, it literally goes into the corners of the country. If oil starts to pick up and we see transport starting to pick up together, I think that is a very comfortable sign that things are starting to improve from the depths we've seen. But I prefer to take those offline companies more like Schneider National or C.H. Robinson to use for economic indicators rather than the FedEx.
Okay. All right. Well, let's take a look at some of the things that are hot or have been hot. First thing I want to do is I'm going to show you back in blog articles. Of course, I write Trading Places blog each morning. And back on December 26th, I thought that we were nearing the bottom. And that day we actually put in the bottom. And in the article I wrote on the 27th, and then you can go back and look at this later if you'd like, but if you look under the current outlook segment or section, I went in and I highlighted the last two bear markets. Here was the breakdown in early 2008 below the prior support levels that had been established in 2007. So there's your bear market breakdown. You can see the reaction highs. You know, once we put in a double bottom here, we had a huge move, 14.5%. The initial pop was 9.5%. You can, you know, I kind of showed you what was going on with the volatility. If you look back at the earlier bear market, back in 2000 to 2001, 2002, you can see that when we broke down below the prior support levels, the initial rally here was 21.7%. So, and this, we went a lot lower after these moves to the upside. So just don't think that in a bear market, the market just goes down. I think right now, what we've been seeing here over the past week or two is one of these rallies. It's a bear market. We've broken down. We're rallying. It's really difficult to say how far we move to the upside. The one thing that I will say is that in both of the two bear markets that I'm showing here, we never saw the VIX go below 16. So the VIX, I know earlier today, was down around 22. As the S&P 500 goes up and the VIX comes down, a bear market requires a certain amount of fear. So I am watching the VIX. I think I talked yesterday about trading more from a sentiment perspective than from actual price support. And I am following the VIX very closely. But I just want to mention that before we get into what's been hot, because even though it's been hot, I'm not sure how long it's going to be hot. First, let's talk about crude oil. Crude oil, you can see bouncing off the earlier low around 42.50, December 24th, 26th. We have seen a nice rally. I think the last time I looked earlier today was about 47.75. This shows the close as of yesterday. So it's probably up another 1% or 1.5%, something like that. But anyway, crude oil has definitely been hot of late, and that has created some opportunities in some other areas. Let's talk first about the pipelines. This is the DJ USPL. Look at the bottom that was established. This was really a panic drop that we saw in the third week of December when we went from 610 in this index down close to 520 over about 7 or 8 days. And that was on top of all the other selling that we had seen in the third and fourth quarters. So we're getting a rally. But when we look at the longer term weekly chart on pipelines, you can see that we've moved down below the 20-week moving average, which we've seen the death cross, the 20 below the 50. And now we're getting an oversold rally. We had the weekly RSI below 30. You go back the last couple years, we don't see it down there very often, but when we do, we tend to rally. The question is if we're truly in a bear market, can we rally back through that 20-week moving average? That's where we have struggled. We got a little bit more room to the upside, but again, a number of these areas that are hot are not necessarily hot on the long-term chart. In fact, most of them are not. But in the short term, we are seeing some strength. In individual stocks, EPD in the pipeline space, look at the huge move we've seen over the last week, 11.37%. But we've been failing at the 20-week moving average, and we're right up against it now. Look at all the volume on the selling. This could just be a quick little snapback rally before we start moving back down. I see more key support down around 22 on EPD. PAGP, this is another pipeline. And again, on a weekly chart, you can see the huge bounce. Key support down closer to $18. Look at this move back at the beginning of November. We had gone below the 20-week. We rallied back up above it intra-week, but we couldn't sustain it. So the question is this move to the upside going to hold, or will we see it revert back down toward the support level? The next area I wanted to talk about is renewable energy. And that's the DW CRE. And when you're looking at this, you can see overall downtrend. But again, right around that Christmas time, we started to see a rally in the renewable energy space. When I pull this up on a weekly chart, check out how difficult it has been to get through the 20-week moving average. We almost did it December. In fact, intra-week, we moved through it and then had a quick reversal, and it got ugly. We do have a double bottom in play this time. And with this low or equal low, you can see the PPO starting to turn up. So this is one that has a chance to make a break above the 20-week. And if it can get through that early December high, I think renewable energy could be starting to turn higher for 2019. So this is one that's kind of, been weak. It's not out of the woods by any means. I mean, we certainly could just see it hit the 20, maybe turn back to the downside and print new lows. But it is starting to build a base, and it's one that it was so weak in 2018. It went from 120 down to 60. So you lost 50% of the value of the index over about 8 months. Wouldn't surprise me to see a turn here. So let's watch overhead. So what stocks in this space? Well, for solar, you can see over the past week and a half, big move to the upside. It's got key resistance, though, up between 47 and 48, and it's not far from that level. Canadian Solar, CSIQ, also making a big move, breaking above key resistance levels or key moving averages. Still got some work up around the 17.5, 18 area. Next up, home construction. This is the DJUSHB. Now, when you look at this, I'm going to go out a ways here, and let's pull up a weekly chart. And I'm going to go back even further. Let's go back several years, maybe 7 years or so. Notice that throughout 2013, 14, 15, 16, a lot of basing where we were really struggling to get above 600, 620. Well, once we did that early 2017, it looked like the economy was picking up. Everything was strengthening. Home construction going through the roof. Rates were still low. But then we got to a point where we hit that 3.25 level. And I'm not saying that should be enough to take out home construction, but it did. We saw a reversal character change on the chart. Home construction, once it fell below that 20-week moving average, you can see it has not been able to get back through it. Now we have 3 bottoms down here around this 600 level, very similar to what I was just talking about on renewable energy. This is a group that has been basing now off of a significant downtrend from 1,000 down to 600. 40% off of the index in 2018 from that high. So this is one that if we can continue to maybe just consolidate here, a break above that 20-week moving average could be very sustainable, especially with the rates back down where we are.
Hey, Tom.
Sure.
I love that chart. I just want to point out that beautiful trend line that would go on your PPO that's almost a year long. And when that's starting to crack with nice positive divergence on the low there, that is a beautiful setup.
Yeah,
so I love that one.
Yeah, and I like the volume too coming in. I think it's just telling us that maybe there's a little bit of accumulation coming in here on this low. And if we get a breakout above that 20-week moving average, it's something we haven't seen in a year. And Greg, you make a great point. Among some individual stocks within the home construction space, Pulte Homes trying to make a triple top breakout today at $27, one to keep an eye on. DHI, this is DR Horton. It's got the double bottom, still got some work to do to get through $38, but this is one that has tended to perform pretty well, especially when the overall group does well. So DHI, I'd keep an eye on. Toll Brothers making the breakout. So this is a little bit smaller company, but you can see all the troubles it had at 34. It's definitely making a move today. Now, a reversal with a long tail to the upside, that would scare the heck out of me. But if we get this confirmed breakout here, I think Toll Brothers has a chance to maybe run a little bit here with interest rates so low as well. Next up, gold. And I know, Greg, you and I was on the opposite side of gold for a long time, but it's hard to argue with the charts now. Gold making a huge run to the upside. I think with the market breaking down, you got folks looking for maybe a hedge. You've also got technical buyers now coming into gold because of the breakouts. I think gold looks good, but I would wait for pullbacks. If we look at the GLD, I think gold was pulling back a little bit earlier. I think you can maybe get this one at the 20-day, like we pulled back in the second week of December. Something like that might make sense. I really like gold, couple of stocks. Newmont Mining, stock putting in a nice hammer today on the 20-day moving average. I think you've got a pretty clear channel that has been developing now over the past few months while the market's been struggling, money rotating into gold and some of the miners. AUY is another one I think that's starting to strengthen quite a bit. I like the volume, and I like these pullbacks hitting the 20-day and rising. Nice PPO as well here. So some of the gold and gold miners I think are worth checking out. Let's move on to gambling stocks. Gambling, DJUSCA, really, if I pull up a weekly chart, I still have some issues. We have been, moving nicely over the last couple of weeks, but I think that we've got some overhead resistance. First of all, the breakdown was around 680 recently. We're just testing that. And like the home construction chart that I just showed you, look at the 20-week moving average. When you get into a downtrend, that declining 20-week moving average tends to be a brick wall, just like it offers up really nice support, generally speaking, during uptrends. So we want to watch that to the upside. I think gambling stocks, maybe we get a little bit more of a rally, but as it gets closer to that 20-week moving average, I would be waiting to see whether or not it can make that breakout. A stock maybe to keep an eye on, WYNN, WYNN. It does have what appears to be maybe a positive divergence beginning to develop. The weekly PPO starting to turn over, maybe getting a crossover here, but we do still have work to do at the 20-week moving average. So it has been hot. We've bounced off the 90 low. Now we're up at 108. What is that, 20%? Pretty good move, but it is now about to hit some overhead resistance. Finally, the last group I want to mention, banks. DJUSBK, when we look at this chart, you can see off of the bottom around Christmas, nice move, trying to get through the 20-day moving average. And here was your breakdown on the bank index around 420. So if we do make this breakout above the 20-day, I think we have a shot to maybe run back up to the 420 area. From there, I'm going to want to reassess. Within the banking space, let's take a look at JP Morgan. JP Morgan off the downtrend. Look at the volume coming in on the distribution here on JPM. Yes, it's rallying, but each day as it's been rallying, the volume's been going down. This is another one. We're above the 20. I think as we get up closer to this 102 area, JP Morgan's going to have its work cut out for it. BAC, Bank of America. These are some of the larger banks, by the way. Here you can see a nice rally, very similar to what we saw with JP Morgan, though. A lot of distribution, very heavy volume. Now we're rallying off of oversold conditions. Need to get back up through, I'm going to say $26 before I would be impressed here, maybe even through that 50-day moving average. So, yes, it's been hot, but it's going to run into some other issues. And when we pull up a stock like Bank of America on a longer-term weekly chart, you can see the damage that's been done here. The weekly PPO is accelerating to the downside. Here, I think you can see the breakdown of that prior support area at 26. And like I was mentioning before, in an uptrend, that 20-week moving average is your friend. In a downtrend, as you get closer to it, I think you want to be really careful. The last one I'll bring up, SunTrust STI. SunTrust, another one, big breakdown, very heavy volume. I think this one looks even worse than JP Morgan and Bank of America. It has rallied nicely off the low, $46 up to 53 and change. If it gets up to another few dollars, I think it's going to run into a lot of problems at that 20-week moving average. So even the what's hot right now, Greg, is you got to wonder if it's just a temporary what's hot.
Yeah,
some of these stocks might be on the what's not next week.
The one thing I liked about both the Bank of America and JP Morgan is they are above the breakdown from the Fed day. So I actually thought they would break out on the Fed day. And when the Fed wasn't listening to the market enough, in the market's opinion, everything sold off. But I would just say it's interesting that the banks have moved back above that level already, even though the indexes have not. And that level on the S&P is 2575. So I think I like the banks here as they start to move higher, and I actually own an ETF playing that trade. But I like the banks starting to outperform, especially relative to that Fed day. So.
Yeah, and I know the yield curve. I think if that goes negative and these banks start to roll back over, the only thing I would say, I don't disagree with you, but as far as the banks go, I would make sure I keep my stops in play because they've been underperforming the market. And when they underperform the market, it's generally not a good sign for equities in general. And
too true.
Yeah, so let's make sure that this strength that we're seeing continues. Make sure you keep your stops in play.
Yeah, I think everything needs to stop in this volatility. Okay, so we should, what's next?
We're going to go into the 10 in 10, and we are right on time. Beautiful. I know, I apologize to everybody. We certainly didn't cover the number of stocks and areas that Mary Ellen goes through. It's amazing how many things she can get through in 30 minutes. But Greg and I did our best to fill her shoes today, and we'll welcome her back next Friday. All right, we are going to go into the 10 in 10. The first stock, and I tell you what.
We don't have your screen on right now.
Yeah, I'm going to go in and take a look at the first one, which is EA. I'm going to pull that up. And Yeah, let's go ahead and start with this one.
There we go.
All right. And I'll tell you what, I'm going to give you the stocks, Greg. Would you mind jotting these down?
Oh, I've got a whole bunch here for you.
Oh, you have them? Okay, never
Yeah.
mind. Okay. Let's start with EA, which is Electronic Arts. First of all, I think this chart looks good in the sense that on the way down, a lot of times what you see with a bottom is a positive divergence. And a positive divergence forms when prices continue moving lower, but the PPO or the MACD or whatever momentum oscillator you use prints a higher low, because it's telling you that the momentum, at least in terms of price, the momentum is slowing to the downside. So prices are going lower, but momentum is slowing. A lot of times that'll signal a reversal, and EA has reversed. But I have still some issues because a lot of times with these positive divergences, we get a reset, and then the trend continues. So notice, first of all, and let me go ahead and just point these out. You can see that, when we get close, any kind of a bounce at all, we don't even test the 20 here on a few of these. We get close there. We test it here. Anytime we're testing that 20 period EMA from underneath in a downtrending stock or on a downtrending chart, we tend to struggle. But when we get a positive divergence, many times we'll see the 20 give way, and we'll actually make our way back to the 50. And so that is about where we are right now. And at that time, a lot of times we'll also see the PPO work its way back to the center line. Now, that doesn't always mean that this is a long-term bottom. And if we're in a bear market in 2019, I suspect that Electronic Arts is not done going lower. So just keeping all of that in mind, I would be a seller at the 50-day and these reaction highs. I'm going to say 85 to 87 is an area that I'd watch really closely. If we could get a big volume breakout above that, I would pay attention. I think that would be bullish. Otherwise, I think that this rally that we've seen is one that I would be selling into. I think it is a typical bear market rally.
Okay, SH.
All right, that is the S&P 500 short. So it's the inverse of the S&P 500. So let me get this chart saved. Okay. So next up is SH, and we've talked about this. I believe the SH pulling back. I'm going to say, I think I did this one recently, but $30 I think would be an interesting 30 to 30.50. I think that would probably coincide, Greg, with that number you threw out there earlier with the S&P hitting 25.75. Yep. I think if we get there, chances are the SH is going to be down into this level. And not that there's any guarantee that the S&P would turn lower at 25.75, but I do think you're managing your risk a lot better. So for the SH, I tend to agree with Greg. I think closer the S&P gets 25.75, and the closer the SH gets down, maybe close to 30. I think your reward to risk in the SH grows at that area.
Excellent. Cliff Natural Resources, CLF.
All right, CLF. All right. Well, nice breakout above the 20-day. I'd like to see it stick. So we do have a downtrend line that I'm going to annotate to keep an eye on. We did have a false breakdown above the 20-day right there. You can see that. So if you leave a tail above a 20 like this in a downtrend, you want to be really careful. Today, we're above it intraday. So one thing to watch for sure would be a reversal where we close back down below the 20-day. If that happens, I'd be much more bearish on this chart. If we do manage to clear the chart on the 20-day on the upside, then I think probably what we're looking at is a little bit more room to the upside. Here was your prior low that we broke below, so that is resistance along with the trend line. I think we got a little bit more room. I'm going to call it 870 or so, 860, 865 to the upside. If we get through, you still got the 50-day. Part of the problem in a downtrending stock or in a bear market is once you get through one level, then you got another level, then you got another level. It's really hard to get back up through all of these different levels, especially if the overall market ends up going lower, which I think most technicians are looking for in 2019. So nice rally off the recent low, probably about 14% or so. I would be a seller as we get up closer to this 850, 860 area, and then see if we can break the downtrend line. All right, what else we got?
EOG.
EOG Resources.
Ego spelt wrong.
Yeah. EOG broke down below the support level that was established back in November. Look at the volume accelerate on this selling. I think the 20-day moving average could be a problem for the stock if it manages to get through and we do see a little bit more short-term strength. Then I think EOG's got a shot for 97, 97 and a half. I would be a seller there. I think probably is going to coincide with that trend line as well. If I draw that in here, it's going to be pretty darn close. So, yeah, I think 97 and a half, 98, I think as we get, if you're talking about the best reward to risk entry on a short side, I think that would be it. So 20-day could hold it. If it doesn't, look for 97 and a half.
Looking for Vale.
Which one?
Vale.
Oh. Yeah, Vale. Is that how you say it, Vale?
Yeah, I think so. Anyway, beautiful trend line on that PPO. Snapped.
Yep, it did snap. It's got some overhead price resistance, but it is coming up with heavy volume. I like that. The ones that come up with light volume, I tend to disregard. Here you can see a prior high. We broke out, came back down, established a support just below that level. And now on the last rally up, we failed. This one, we've got a little bit more volume coming in. Today's volume is really heavy, so I don't know if there's news out on the stock or not. But a breakout above 1435, 1440, I think would be a very bullish breakout on VALE.
I think it's just because the Dow's up 800. Everything's flying. So we got Dan next. DAN.
All right, that's an auto parts company, I think, isn't
it? You bet.
It?
Yeah.
Yeah. All right, let's take a look. I typed in there one too many A's. All right, Dan. Nice break to the upside. Positive divergence. Again, you can see the PPO higher, prices lower. Now we're getting what could be a reset or it could be a permanent bottom. Again, with the overall market, the bear market that we're facing, my guess is that this is just a temporary bottom that we're rallying, bear market rally, and I expect we will go lower. But let's see how we finish today. I mean, we are through the 50-day moving average. I'm going to annotate and just show the most recent price high. You've got a gap resistance level right here that also is marking price highs near 15. I think that's a level where you're going to see some more sellers show up. Let's see if we can get through there. Close above the 50 would be the first step. But as you can tell, I'm a little bit skeptical of this rally because of the recent breakdown in the market. I think that we could still have a little bit more upside, and I think that could carry Dana up to about the 15 level from there. Let's see what happens.
Okay, and the other auto parts guys are doing pretty well. ATVI.
Right, ATVI. Activision Blizzard, positive divergence, but I got to tell you, and I've talked about this before, when I get a PPO reading goes down to -10, that's pretty stretched, and sometimes it doesn't really need to do anything price-wise to the upside, or it's all. My point is, it's almost natural for a stock to begin to lose momentum to the downside when it goes down this fast. Activision Blizzard was $85 in October, and by the time mid-November rolled around, it was 47. That's a pretty big haircut in about 6 or 7 weeks. That type of downside momentum is not likely to continue. It's almost a mathematical certainty that you are going to see this PPO turn up. So even though we've seen this turn up, and I know, Greg, you would be looking at this downtrend, I think you got to be careful. When you see heavy volume selling and you get a PPO that goes to this level, I think sometimes you get these false signals, and I think this is one of them. The stock's continued moving lower on very heavy volume. I do think eventually it's so oversold we'll get a rally. I would suspect we could get a pop if we get through the 20-day moving average. I would be looking maybe up closer to 52.5 to test the last reaction high. I don't think we'll get through there, though. So first you got the 20-day, then you've got a key price resistance high around 52.5 and a declining 50-day moving average. I don't like Activision Blizzard. I think short term, maybe you'll get an opportunity on the long side, but further down the road, I see this one going lower.
Okay, URI, not you and I, but URI.
All right, United Rentals. Another one downtrending, continue to put in lows. You're seeing the positive divergence, but again, overall, I think volume trend's been pretty weak. I think the stock's got some work to do. I'm not going to be overly impressed until I see it take out that last reaction high, which was right here at 113. That would also clear the 50-day moving average. So a good first step. You can see the last couple times we've gone through the 20-day moving average, we've seen failures. So I think this is a good first step. I think there's more work to be done here. Closer it gets to 113, the more I like it on the short side.
Okay, our next stock is a jumbo, BA.
All right, Boeing. Boeing also with the positive divergence, and keep in mind too that you don't connect the lows or the intraday or the opens. PPOs, MACDs are based on closing prices. So when you're using candlesticks, make sure you're getting closing prices. But you can see clearly lower closes, higher PPO, making a run. I think the big volume sell-off that we saw back in early December, we struggled to get back through 335. I think that is going to be a problem for Boeing as we move up. So we are at 326 and change. I think you got a little bit of room to the upside. I'm going to draw, well, let's go all the way up to the top of gap resistance. So I'm going to say right in there somewhere, if we continue to strengthen, that we will see a reversal on Boeing. So short term, I think there's room to the upside. Further out, be careful.
Okay, we're going to squeeze one more in.
Yep.
INCY.
All right, INCY. Nice looking chart here. Big move to the upside, threatening the recent high. I'm going to go back a little further on this chart. Let's go back a year just to see if there have been multiple tops. Yeah, you can see after a huge gap down back in April, Insight now making a move. Also, by the way, I'm going to pull up one other thing here. I'll come back to this chart. I want to show you the seasonality because from what I recall, this stock has tremendous seasonality. It was either December, January, over the last 20 years. Okay, November's 5%, December 2.6%, and look at January. Averages going up 8.4% during the month of January over the last 20 years. So now when we take a look at this chart and all of a sudden we see it breaking out, to me it's more, there's more meaning to it because this is what it tends to do seasonally. So the big breakout, increasing volume. We do have a little bit of overhead resistance we need to watch around 75. But if we get that breakout, knowing what this stock likes to do in January, I like it. So let's keep an eye on INCY.
Perfect. And that wraps up 10 in 10.
10 in 10. Well, it's probably more like 10 in 13, but we're not going to split hairs.
That's a fib ratio. So
there you go. All right. So there's the 10 stocks that we just went over. Now we're going to take a look at the market update. And I'll tell you what, after this market update, Greg, I don't know if you have anything to add on an intraday basis on what's been going on, but clearly the market has been incredibly strong. So if you have any other charts that you want to add when I'm done,
okay,
the market update, I'd certainly love to hear about it. But let's take a look at my charts. Sorry, just trying to get these up for everybody. Just going to go over that candle glance that I went over at the beginning of the show.
For some reason, yeah, there we go.
Okay. All right, so the Dow Jones Industrial Average, as Greg was mentioning, rolling to the upside, currently up 800 points. The S&P 500 up 86. And by the way, 2532 was the intraday low back in February. So we are beginning to work our way back up into that zone from 2532 to 2581. That is kind of what I was looking for as an initial bounce off of the first initial bear market low that we saw in December, and we're getting there. So just wanted to point that out. The NASDAQ up 277 points today. What a day. Huge day today. Russell 2000 also having a monster day, up 49 points, trying to get through its 20-day moving average. 10-year Treasury yield climbing. It is at 2.67% now, up 12 basis points. I can't remember. It's been a long time since we've seen the 10-year Treasury yield jump like this. Of course, it comes off of the heels of a huge decline, but still 12 basis points is a lot on the 10-year Treasury yield. Volatility index continues declining, down at 22. It is down 12.5% today. Just keep in mind this 16, 17 area where we saw bottoms in November and early December, they mark tops in the stock market. As we get closer to these levels, if we get down there, I would be very careful. Technology continuing to perform well, 4.5%. Communication services, 4.13%. Both of these groups being led by industry groups such as software, which is now up 100 points today, and the internet group up 65. Intel, AMD among the best performers in the Dow and the S&P 500 respectively, both semi stocks. So I don't know if you had anything to add, Greg, but we've got a few minutes before we get into our final segment. And I don't know, this is a nice rally. Do you think it's got more legs, or do you think that's...
I do. One of the charts I like to look at, and let me just see if I can share the screen briefly. I'm just going to go to share. So I have a top 10 that I like to watch, and I basically just try to keep track. This is a 60-minute chart with a 100-period moving average on it, which is right there, and we've just broken through it. Now, it doesn't look like much, but see how the MACD came up, rolled down, and on the 60-minute just touched zero and does a Tom Bowley reset right there. I'm going to scroll to the bottom just because I want to change this chart settings to multiple months here and just give you a better picture of this. But just simple things like being aware of what the momentum is doing. And so when you get this is our first bullish turn going back. There was a little one there, but basically since this whole thing started, this is the first time we're turning up above zero. So this to me is a really bullish setup. And I think we get up and at least test this 2600, 2625. That would be an area I'd really want to look for. And again, always in a big market downtrend, know where the 200-day moving average is and the 100-day. Those are all important to just be attuned to what might be resistance. But I love this setup right here, that this is starting to turn up, and just this 100-period moving average, the VIX is falling below it.
Hey, Greg, can I ask you a question?
Sure.
So you talked about the fact you're doing lesser positions, maybe smaller positions, but you're on the long side right now.
Yeah.
As you see the S&P 500, is your strategy going to be to sell along the way? Are you waiting for 2625? I mean, what...
I will look for a divergent high. So I'm on some sort of move up here. I'll either just draw trend lines under these, and when they start to break down, I'd lighten up. I don't really need to wait for this sort of, I'll call it abrupt trend change, but I think we're in a big bear market, but I think we get this rally. When I looked back in 2007, it basically got up to the previous high, which I'll call the October lows, or sorry, the previous lows. Call it 2625, 2600 if you want to worry about it. But right in this area, I would expect lots of resistance to show up. And the main reason for that resistance is it's going to be people saying, just get me back to where I was. I just want out. And the moment that selling starts, it's going to be a lot harder for us to try and push through without some big sort of helpful intervention by, some positive news, China trade news, whatever it is. But I would expect some big selling to start to show up there. And so all of these markets, here's the 100-period moving average, they're all sliding down. I think, I always think commodities can trade separate from the markets. They can be very radical. They can do whatever they want. They can, in 2008, oil went to $149 while the market was falling down 20%. So I like to trade commodities just because they can be unrelated, but everything right now is a trade. There is nothing that is long-term hold, because I think our bigger picture is maybe jog sideways for a couple of months and then have a tough summer. So.
Okay. Yeah, I would tend to agree with you. I think that we're going to have tough summer as well. I think the minimum upside that I was looking for on this rally, I wanted to see it get back to the 2532 level. That was the low that we saw back in February on the S&P 500. We've done that. We're actually above it right now. 2581, I think, was the prior close, which was back in February. That had been holding throughout 2018 until December when we had that big drop. And then finally, what I would also keep an eye on, because sometimes these rallies go further than you think they're going to go. I think the S&P 500, I agree. I think if it gets above 2600, I would watch the 20-week EMA on the S&P.
Yeah,
that
agreed.
is 2677 right now. I don't believe we close above that. I'll be surprised.
Yeah, and that's the 100-period moving average. And this, by the way, everybody, the 2575, this is the Fed drop off right here. And this was the Fed meeting right in here. And so we basically went down all the way into the Fed meeting and had a drop off again right here this November. I think it was early November. I think this was a little bit of a Fed rally, and then this whole thing just unloaded. This was the last Fed meeting. So if we can get back above one of these, it would be a nice start. But unfortunately for Chair Powell, market hasn't. Every Fed meeting we've kind of sold off after. So,
and I think the other thing too to watch for is not only the volatility index going back into the teens, because that normally in a bear market, if you look at the last two bear markets, we never went below that 16, 17 area. I think that can give you a little bit of a clue too. And watch for reversing candles. I mean, in a bear market, all of a sudden you think everything's great and you get that impulsive selling to the downside that we want to keep an eye on. So keep all of that in mind. But great chart. And also just want to clarify the 100 period that you have on there is 100 hour.
Yeah, and 20, that would be a 20-day.
Right, right.
But I just want the candles. I want the little candles to show me that that MACD, right? So,
Yep. Gotcha. All right. Well, we are going to go into our final segment. This is always a fun one because we're going to have differing opinions. I know we always do. And we'll probably have different opinions than everyone else out there. And that's fine. That's what makes a market. But the What Would You Do segment is going to be the last one. Greg, you're going to start it. And the topic is Apple. I mean, obviously, it's been in the news. Huge disappointment. I mean, we haven't seen anything like that in 17 years, I think, them lowering their revenue guidance like that. What would you do with Apple?
Okay. So first of all, let's just step way back. This is big picture. This is Apple coming out of the iPod, and the iPod came out in 2001, 2002, somewhere in there. And basically the market just kind of hung around, and then off the lows, Apple was one of the big movers, made a huge run, introduced the iPhone, rolled all the way back to the introduction of the iPhone. So the stock doubled and then pulled all the way back in 2008. So you're in the greatest company in the world with the iPod and the iPhone, everything going ballistic, and the market gave back almost 70%. So just because you're in a great company doesn't mean it's going to hold up. But anyway, so we run up and we make this big, huge move, and we can all see that this is, a fabulous stock and been a fabulous story. I have two lines on here. One is the relative strength against the S&P 500, and I want this to hold a lot. It's already broken this shorter term uptrend on the monthly, and we'll get into that on the next chart with my weekly analysis. But just look at this PPO, and what it's telling you is that on every rally, we're getting less and less improvement. So this was our first initial thrust, and then it was a lower high. No big deal, but in general, I like to keep track of all of that. Now, here, you could draw a trend line up here and it would crack and show this market pulling back. You could do it again here, and now you could do it with this really big area going back from the 2003 low. The only thing I would say is one of these rallies is going to be the final one, and the problem that we all have is trying to figure that out. And so if you just went back to Microsoft, and what you see is Microsoft ran up and it fell apart, and right in here the stock lost 70%. But then what happened is Microsoft did nothing for years. It was basically dead money, and I think when Satya Nadella came in, that's when the stock started to accelerate. But you look at this big uptrend here, and when that trend breaks, multi-year, a big long-term uptrend, and in this case it was actually parabolic, but when that trend broke, it was a pretty good clue that you wanted to leave. And you have to remember, at that point in time, everybody thought Microsoft would be the stock for the next century, and the reason was because Y2K had come and everybody had put in Windows systems, and it was exactly the top, not the bottom. So with Apple, the one thing that I'm just keeping track of right now, out of all of its peers, Microsoft, Netflix, Disney, kind of the top new stocks of the day on the NASDAQ, you're seeing, Apple way out of favor here and really continuing to make lower lows, and everything else has started to deflect up. So I'm not comfortable that Apple's got a lot more upside, but I have one more chart that I want to show. And what it is it's a weekly chart with Apple. And again, here's this relative strength trend line. And they need something really big, and I don't think it's going to be a watch, but if you go to Mac Daily News, what you'll find out here is that the Apple fanboys, or the people who really like Apple products, are very upset about all of the Apple products. But I want to show this in particular. So here's the '08 low. Here's the 2013 low. Here's the 2016 low. And we've now broken this uptrend. And if you follow my weekly wrap, you'll see that when these uptrends break, and it broke on oil recently, this is a big deal. But this is a 15-year trend line for Apple, and we've now broken it. And so I think, there's some people on TV who have talked and used the words like, don't trade Apple, own it. I think it's now, don't own Apple, trade it. And I would be very focused on that. With this weekly breaking down to below zero, that's a pretty scary place on the Apple chart. And again, this big downtrend in PPO continuing to drift lower suggests to me that the stock, for the most part, it was $1 trillion stock. Everybody said it's going to 2 trillion. I think that was only 3 weeks ago or 2 weeks ago. Somebody said it was going to 2 trillion. But, much like the curse of predicting the market forward, I would just say the price action is telling us that something has changed in this stock meaningfully. And, 2011, sorry, the iPhone has been running up, and lately we've had the watch, and they've tried to rekindle the iPad or redo the iPad. With all of that, I think the big issue here for Apple is that the long-term trend lines are breaking and the long-term momentum trends are breaking. And so it would be trade it, don't own it anymore. So.
Okay. All right. Well, that's an interesting take. I've been looking at Apple, and of course, I'm a short-term trader. I don't buy and hold anything. So, when I look at the chart here, I'm going to show a similar chart. This goes back 15 years, a monthly chart. I will say this about Apple. In my lifetime, it is probably the most innovative company that there's ever been. I mean, you can certainly talk maybe now about with Amazon, and maybe over the next 10, 20 years, it'll be one of the others like Netflix, or maybe there'll be a new company that's, much smaller that will become incredibly innovative. But Apple has a ton of cash, and yes, things are slowing. Apple, I don't think Apple was priced for perfection like some other companies, but it was still, for the size company that it is, it still had a reasonable amount of downside room to go. And I think it's going to go further to the downside. I don't think that you just come out with one warning and all is good again. I wrote about this a little bit today. I think that when I look at Apple and I look at their stock before their warning, I think that's a good thing. I think the fact that it was going down prior to the warning, which, by the way, the warning comes out before their earnings report, I think they handled it the right way. This is a company that's been very conservative in their guidance over the years. Traders have grown accustomed to them outperforming their guidance. And so I think that the whole U.S.-China trade thing caught them by surprise, as it did many folks. I mean, you looked at the U.S. market in July, August, September, and everyone kept saying, well, we're immune, we're immune, we're immune. Well, we're not immune. And the fourth quarter showed it. Blame it on whatever you want to blame it on. You can blame it on the Fed. You can blame it on the politicians. You can blame it on whatever. China, U.S. trade. There's a number of things that we could zero in on. But the point here is that this is a company that has been extremely conservative. And I think you're going to see it continue to be conservative in the days, weeks, months ahead. And so I think they're going to look at this, and they're probably sitting back right now talking about the fact that, hey, we've just been humbled. Most companies go through this quite often. Apple has not, because they have been so innovative. They've been able to tie so many of their products together. It's been like this huge empire, and it has begun to unravel a little bit. My bet, though, is that they don't completely unravel. This is a company that's got a tremendous amount of vision. They've got their web in everything. I think, yes, iPhones are slowing. I think a lot of folks were expecting iPhones to slow the sale. And so I think they're going to become a tradable stock again on the long side. Not yet, though. I think, again, we have more downside. I always go by that old Wall Street adage, there's never just one cockroach in the kitchen. And so Apple coming out and warning here. I don't think if the U.S. and China tomorrow morning said, hey, here's our deal, we got it, it's done. And the Fed, of course, Jerome Powell already came out earlier today and said that, he essentially will kind of watch what the market is doing. He admitted that, hey, his data, we were talking about this before the show, Greg, his data is suggesting that things have not slowed, that they need to kind of keep an eye on it and continue to, be somewhat hawkish. But he did admit today that, hey, if the market is telling us something and we begin to see it in the data, we're going to be patient. We're going to watch. I think there was even the subject broached about whether or not that 50 billion the mortgage securities that are being unloaded on the balance sheet each month. He even said that, hey, we'll even look at that if we have to. So the market liked what he said, and that's why we're getting this huge rally today. But I think if everything positive hit all at once, I think that the rally still is not going to last. I think we're going to roll back over, and I think we've got some pain to deal with in 2019. So I think Apple goes lower. Looking at this chart, how much lower? I think this breakout right here at about 125, I'm going to shorten the chart just so we can get a little bit better look. So I'm not going to be nearly as bearish. I know you said that this is an opportunity still to trade it, but not to own it. I think it's going to get up to a point where it's going to be a pretty good buy. I think that the breakout right here above this 2015 high has not been retested. That is about 125. And I think if we went to a daily chart, there's even a gap in here. It might be right in early 2017. But I think the 120, maybe even into the 1-teens, up to 125. I think that's going to be a range to watch for. And Apple's going to bounce. Apple is very oversold now. You can see the 20-week moving average currently is at 183, and the stock's at 148. I don't know if we bounce from here. I think I'd like to see a positive divergence begin to develop on the weekly chart, similar to what we saw, back here in 2016 before we ran up. I think it's too early, but we will probably stabilize on Apple in the short term and then perhaps make one more push to the downside. And I told you earlier, and I've been writing about this, I think we are in a secular bull market, and we are going into or have entered a cyclical bear market. And I think it's going to present a lot of great opportunities on some of these companies, including Apple, that I think it's going to get to a point, and I know you disagree, but I think it's going to get to a point where it could be a very good buy and hold as we go forward, because I do believe in their ability to innovate and to generate revenues and to generate profits and cash flow. And I don't think that will be lost on the market as we get deeper into 2019 and you have cheaper prices. So to summarize,
yeah, go ahead.
Yeah, I was just going to say, to summarize, I think it's we're going to go lower. So I think it's better to wait. I think that you will get Apple at a cheaper price in 2019, and I think we might actually bounce. I mean, if this market keeps going up, I could see Apple easily moving back up into the mid 150s, 160s short term. But I do think we go lower, and when we go lower, I think it's going to create some opportunities, and I would be interested in Apple at that point. So there's the summary, and we can talk about it some more, but I just wanted to pull up the summary there. So Greg is saying weekly uptrend broken, avoid it, but still trade it from time to time. Just don't own it.
Yeah.
And I think there are going to be better opportunities from a trading perspective and from a buy and hold perspective.
And on those PPO trend lines that I mentioned, like I find the daily PPO a little too whippy. Like I really like on Apple, if you look at the two previous lows, you can draw a trend line straight across the PPO. And when that broke, that was a really nice entry. And so just keep your eye out for something like that. Momentum has to change before price changes. So in other words, when a basketball bounces, it goes up and it actually stops going up before it goes down. Same thing should happen in price action, where the momentum actually improves. So it stops going down and the down momentum stops and it actually starts to make higher momentum. And usually the price starts to follow after that. So in order to see the change in Apple, I think you could be patient and you'll get better opportunities.
Okay, well, here is the poll, and this is how everybody else responded. well, I don't know if it's fortunate or unfortunate, but I'm in with the majority who are saying, wait, there will be better opportunities. But I also say that that is the mindset that we get into when the market and a stock like Apple goes up for years and years. It's like, okay, yeah, we're pulling back. Everybody's getting used to the fact that, okay, things aren't what they were 3, 4, or 5 months ago, but the market's going to resume back to the upside. And sometimes bear markets have a way of completely changing your mindset over time. Greg, you went with weekly uptrend broken, avoided. 13% agree with you. 21% not interested. That's kind of interesting considering that it's one of the icons in the U.S. market.
And it's probably in every portfolio, either through an index or through, if you're a professionally managed portfolio, I'm sure the top 5 FANG stocks have been in there for years. So almost everybody's sitting there holding some Apple one way or the other, I think.
Yeah, now here on, and I'm going to switch over to a chart in just a minute, but talking about this shorted on strength, 17%, and buy it now, 10%. I think in a nutshell, that is what the stock faces as it moves forward, because you're going to have a lot of folks waiting for that bounce to short. You're going to have a bunch of folks, fundamentalists, that think, oh my gosh, this is a dream come true. Apple was 230, 3 months ago, and now I can get it at 148. So you got these two factions that are going to be battling. But I'm going to go ahead and pull up this chart on Apple. And you were making a comment earlier, Greg, and I think maybe this will hopefully, if you see my chart now?
I do, yeah.
Yeah, so, okay, take the 2012, 2013 drop that we saw. And this was a pretty big drop, as you mentioned, 90 down to this first low here at 50, almost a 50% haircut. And you look at the PPO, what's going on, and now you look at what's going on here and with the PPO. I think what we're seeing is something very similar. But what ended up happening is we did still go lower. And when we went lower, we managed to put in a low at $50 that ultimately the market could push off of back to the upside. Notice, though, on the initial bounces, we would go up for a couple of weeks, 2-3 weeks, but then we would resume the downtrend. So I think that's what we need to be looking at in early 2019. Apple at some point is going to rally for a couple of weeks. Probably won't be a lot, but it could be 10%. I'm going to say maybe 10%. Eventually, though, I think it starts to work its way a little bit lower, and then we bounce. But I'm going to leave you with the last 30 seconds. What do you think about Apple here?
I would just draw a trend line on that top left PPO from there all the way down to the July low on 2013. And just, you see how those kind of, not that one, the next one, that one there.
Okay.
Yeah, just kind of, in general, your eyes are taken down to about that point. I mean, you're trying to find a low in the stock, but the momentum is starting to improve at that point, and that higher low is what you want to look for. Conversely, if we go over to the 2016 low, we get the same thing where that first higher low is a better spot. So anyway, I think those are good options.
All right, very good. Well, first of all, I want to thank you for joining me today. It was on short notice. I appreciate it. I know all of our listeners appreciate it and your take on a number of different areas of the market. So again, thanks, Greg. There was our upcoming schedule. I want to thank all of you for being with us today. I know it's a tough market. Stick with us. We'll try to help you through it. Please remember to complete the survey as you exit. It is located below your video player. Love to get your feedback, hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everyone. Enjoy your weekend. We'll see you back here on Monday. Happy trading.